Hi there, my name is Jeffrey Luke, and I would like to thank you for taking the time to watch this video. So I'm a photographer in Seattle, Washington, and I am also an investor. When I started my photography business, I also had to learn how to invest. And so over the years, I've had to really take some time to get a really good understanding of what works and what doesn't in investing. And so I just wanted to share this with you guys because I know a lot of the people who are watching this video are just starting out and there's a lot of information available and sometimes it can be a little bit overwhelming. So what I want to teach you about is going to help you to, build a solid base, a foundation for understanding investing, and that will help you going forward as you kind of plan out your own investing future and hopefully build yourself a solid financial foundation and get the freedom that you want that comes from saving some money now and investing it for the future. So have you ever noticed that some people really want to start investing or start with anything big in life that could help them, but they never really start? It's like there's something that holds them back and then they get distracted by life and they never begin. Well, I've noticed that's the case with investing, and I think a lot of the reasons that people don't take that next step is they just don't have enough information, or they don't have a clear idea of where to start, what would be that first step, and then once they do that, what's the next step. And so without ever knowing, it's like people just get stuck. Anyways, I think the best way to get unstuck is to learn and to have somebody who can sort of help you see along the way, somebody who's walked that path before, someone who's invested and can tell you a little bit about what works, at least what's worked for me, and you can use your own judgment and decide whether you think it would be useful for you. So first thing I want to tell you about, it's a quote, a really simple one, by a mathematician named Carl Jacobi, and he said, "Invert, always invert." So what does that mean? Well, invert is just another way of saying turn things upside down. Flip them and see things. If you're trying to solve a problem, this is really good for solving problems. Think about things in the totally opposite way. So I'm going to give you an example. Say that you wanted to lose weight, right? Ask yourself, what would be the worst thing you could do if you were trying to lose weight? All right, the answer is probably sit around and eat a lot of junky foods, whatever. Just eat snacks, have lots and lots of chips and ice cream and cake, and then don't move a lot. Don't go out for a run or ride your bike or go swimming or take a walk or anything. So just got it, right? So what's the opposite of that? If you invert that, well, it would be get outside and move around and don't eat so much. Just moderate your portions, right? So just flipping things like that. Another, if you wanted to get a job, okay, what would be the worst way to get a job? How could you ensure you'd never get a job? Well, another one would be, stay at home, don't make any phone calls, don't send out your resume, don't network with anybody, and keep quiet about the whole thing. Just make very little effort to let anybody know that you were trying to find a job, okay? So flip that around, and what do you got? Get out there, meet people, network, make a resume, show it to people, tell everybody you know that you were looking for work. So, this is a really, I think it's a really solid tool, and it's one that is not taught in schools that much. I've never learned it in school, but just whenever you're trying to solve a problem, try to invert it and see what you get. Okay, so this leads into what I want to teach you about today, and that is how to choose stocks, how to pick stocks. If you've decided that you want to be an investor and you don't want to go the more safe and sound route, which is actually what I recommend, I think that index funds make a lot of sense. I know some people think that they're boring or that the returns aren't going to be that great and that they can somehow beat the returns of a low-cost index fund that you invest in, say, every month. But I realize just because that works for me and I like it, it doesn't mean that everybody who's watching this video or everybody out there also wants to do the same thing I want to do. So I just want to give you some options in case you decide to go your route, which is perfectly fine. Everybody has a different approach to their own success. So if you want to choose stocks or pick stocks to invest in, first off, I recommend buying stocks and holding them for a long time. I don't think you're going to do well buying and selling. Trading runs up high costs, high taxes, and every time you buy and sell, you usually pay a commission. And even if you find a way to buy and sell that's really low cost or no cost, still that process of buying and selling, the mindset is very different. It's more of a speculative or a gambling approach as opposed to an investing approach, which is to grow your money over time and get a solid return without losing it. So anyways, let me go ahead and tell you a little bit about my recommendation here. Okay, so, and first, before I put this up on the board, what would be a good way of finding an investment in companies, let's just to invert, that would be a really horrible investment, okay? First thing I can think of would be invest in a company that's not profitable, okay? So if they don't make any money or they don't earn money yet, then that would be a good way of at least starting to figure out a company that would be a bad investment. Another way, they don't adapt, okay? Times are changing, technology, all these, things are changing so much in the marketplace and business today. So a company that can't adapt. What's another thing? They don't have very loyal customers. And, people sometimes buy from them, but then a lot of times they just search for a cheaper option or some other company. Another one, really easy to get into that business. So that, if you're running a business, you're selling stuff, somebody else could really easily duplicate what you're doing and knock you out of business. And then another thing you wouldn't look for is something that's really expensive. So, if a stock is super expensive, selling at a really high price, much greater than its value, then that would be something to stay away from. So, let's invert that, okay? Palms, all right? So I set this up, so all you have to do, if you ever forget this scenario, is look at your hands. Look at your palms. You'll always remember this. First one. You want to invest in companies that are profitable, okay? If you're going to choose a company to invest in, why waste time and why waste the energy, and then finally, why lose money? Because you've invested in some company and you're hoping they'll make money in the future. It doesn't make a lot of sense, all right? There are a lot of people out there, let them lose money, let them gamble and put a lot of money into a company that's, listen, some companies that aren't profitable eventually do have great success in the future. So I'm not trying to say that's impossible, but I'm saying my advice to you, look for a company that's making money. So, these are filters. So what will you filter out at this very moment? Snapchat, okay? It's a very exciting technology. The app is really cool, but the company's not yet even profitable. So I'd say that putting money into that investment at this point would be a speculation. And if I were to recommend to you what to do, that would not pass the filter. Blue Apron, there's a company that just went public a couple weeks ago and the stock is just dove. It's not a profitable company yet, and so if you were to buy into that IPO or buy stock in that company, you would just be hoping the price goes up, but that doesn't have anything to do with the fundamentals. Tesla is another company. It sounds like a really exciting company, a great idea, but Tesla, they're not making money. So any investment in that is hoping that things will work out in the future, but that is not investing, at least in the way that I would advise doing it. So a company like Tesla would not make the cut. What are a few companies that are profitable, just as examples? Okay, Starbucks. Starbucks has been around since 1971, I think. Profitable company. Microsoft, they just released their recent profits and they did really well this quarter, but they've been, they have a history of doing really well over years. So you're buying a long-term profit history. Nike, McDonald's, Costco, these are all companies that have been around for a long time, and they've proven that they can make money. So there's the first one. A, adaptable. So you want to buy into a company that is nimble, that can move. Even though it may be a big, well-established company, you want a company that's with it, that changes with the times. One company that comes to mind is Starbucks. You know, what they do, what they sell, started out as just coffee. They realized more and more people, they were in there to get a cup of coffee, they would then want to get something to eat, so now they, you know, offered lots of different things to eat. And then they've recently given a lot of thought into how people pay for stuff, and so they have this mobile ordering platform, and they created an app, and it makes it really easy for users to pay for stuff and order before they even get to the store. So you want a company that is adapting and changing and staying really flexible, as opposed to one that's kind of stuck in the past. And, you know, just as an example, like Sears, they're still in business. It's still a company, they sell stuff, but they haven't changed with the times, and they're, you know, winding up getting totally outcompeted by so many other retailers like Walmart and Target and, you know, everybody else who sells stuff, Amazon especially. So you want to look at companies that are adapting and changing. Amazon's another great example. I mean, they started out selling books, then they started selling electronics. Now you can get groceries at Amazon. You can get streaming video from Amazon. Then they have this huge Amazon Web Services, so they're, you know, involved in cloud computing. Amazon's an amazing example of a company that is growing and is also adapting and changing constantly. So look for adaptability. L, loyal. You want to look for companies that have loyal customers, you know, stickiness. A company where people love the product and then they come back to it again and again. Not like they go there once a month or once a year and that's it. You know, look at Facebook and Instagram. Instagram's owned by Facebook. I mean, people go to Facebook every day. They check it several times a day. Now they've got apps so you can check your Facebook update and you can check your Instagram, and people are always flocking to their platforms. And so Facebook's a great example. Amazon's another. You know, they get people to sign up for their Prime services. Then when you're with Prime, you're saving money. You're getting free 2-day delivery on a lot of stuff and free streaming video. So they've been managed to get their customers to be very loyal to them. And when it comes to buying stuff, people think of Amazon first because of the free delivery and stuff like that. So loyalty is huge. If you want to invest in a company, use that filter. Ask yourself, is the company I'm thinking of investing in got a lot of loyal customers? And if you look for that, you will ensure that you're at least investing in a company that for the time being, and you will hope into the future, will maintain those loyal customers. M is for Moat. And Moat comes from, you know, big castles. They have this big waterway that go around them, and then they keep all the invaders out from invading, storming the castle and stuff like that. So with a company, you want to invest in companies that have a durable competitive advantage. And that's a formal way of saying it's going to be really hard to knock them out of business. You can try. For example, Coca-Cola. You know, if I gave you $1 billion and said, I want you to invent a soda brand or a cola brand that's going to outcompete Coke, you couldn't do it. A lot of people have tried over the decades, but Coke's been around since 1896. Nobody's been able to push them off the perch as the best and, you know, the best brand in soda. So, you know, you want to look for things where you really couldn't push the company off their perch. Nike's another great example. I mean, they're pretty much the top sneaker and apparel manufacturer, and sure there are other companies like Adidas and Under Armour, but they're just a small fraction of the size, and they don't have the sales or, you know, anything that some of these established companies with a big moat around them have. A couple other moat companies would be, well, Amazon's got a great moat. It'd be really hard to build like a website company to outsell Amazon. They've just got such a distribution network and so many customers, and it'd be hard to push them out of business. Starbucks, you know, a lot of companies would love to sell coffee, sell espresso, but Starbucks has a very wide moat around it. It's going to keep a lot of competition out of their space. CVS, pharmacy chain, and then they've got a lot of great efficiencies of scale. Visa, the credit card company, even MasterCard, and another one would be Microsoft. You know, Microsoft's been around for a long time. They've got a big moat around them. It's hard for other software companies to come in and displace them. A few companies that don't have a moat, Walmart, you know, Target, Best Buy, Macy's, you know, these are companies, even the Gap. The Gap makes great clothing, but really it'd be very easy to go into fashion and create clothing and make styles and fashions that are similar to the Gap and sell them. So these are reasons why I would not, you know, super recommend getting into companies where it'd be easy to kind of duplicate what they're doing and outcompete them. And finally, S. Sensible price. So, you know, it's great if you get all these things here done, but if you pay way too much for a company, you're going to be in trouble in the long run, because what you pay to buy stock has a huge impact on your total returns over time. If you buy something and it's, you know, $350 a share, and for whatever reason you paid way too much and it goes down to $150 and never makes it back up to $350, as long as you wait, you'll never get your investment back. So the price that you pay when you make an initial investment matters a lot. So you really want to pay a price that makes sense when you consider the normal vicissitudes of life, the fact that the stock market goes down, it goes up, economies change, we can hit recession. So you want to be mindful when you buy something, not just to pay whatever the market price is because you want to buy it, but you know, be careful about it. These are hard things to pinpoint if you're just starting out, because it's impossible to forecast where the stock market or the economy are going to go. But I think if you look carefully and you do some research and you read a lot, you'll get an idea of which companies are probably way too expensive, and you can avoid investing in them. So there you go. Palms. You can remember this just looking at your hands. And I think if you pay attention to just ask yourself these questions, if it meets these 5 criteria whenever you're considering a company, and if it doesn't, if it fails on any of them, then I would just weed it out. Don't even bother. Don't waste your time on it, because there are going to be companies out there. They're not going to be easy to find, because if investing was really easy, everybody would get really rich investing. It's not easy. It takes time. It takes patience. But if you do the work right, you'll be able to find some good investments. And also keep in mind, you know, the great investor, Warren Buffett, he said his best advice to anyone starting out is to imagine that you have a punch card when you begin your life. And it's got 20 punches, 20 little holes you can punch out. So you can only make 20 investment decisions in your lifetime. So he says if you approach it this way, you'll be much more thoughtful about each one. And rather than just jumping into some stock because you heard about it or it excited you at one moment, you'll really be thoughtful about it. And if you approach things that way, you will be much more thoughtful in your research and more deliberate. And then you will only buy it when it really makes sense. And you know, when it reaches all these criteria behind me and you think, you know what, this makes sense, and you can explain why in, you know, simple terms, then you know that looks like it'd be a more sensible approach than just feeling like you can buy as many stocks as in your lifetime as you want. That way you're a little bit less, do less research when you choose each one. So I hope this info is useful to you. If it is, I hope that you'll give a thumbs up to this video. You might also like to subscribe to it. And if there's anything I didn't cover in this video, please put it in the comments below. I will check them and I will respond to you. So if there's a video you'd like to see about anything I haven't covered, just let me know and I will do my best to make a video about it. My name is Jeff Luke. I want to thank you for taking the time to watch this video. I'll see you next time.